Right, today I will be focusing on what we call the elements of financial accounting, the elements of financial accounting. Everything that we report in our financial statements is based on what we call the elements of financial accounting. Now, these elements are 5. Your understanding of these elements is very, very important for you to be able to understand accounting. So before you proceed to the next topics, please, you have to make sure that you have thoroughly understood these elements. Why are they important? It is because almost every topic that you shall do in your studies throughout the semester will be affected by your understanding of these elements. That's why we do them at the beginning. They will affect almost everything that you shall do. So it's really very, very important that you understand what we are doing. Right. Now I'm going to share with you a screen. It's an Excel sheet, so I think you can now see it, where I'm going to be illustrating what I'll be covering today. Right, so we'll start by looking at the elements of financial accounting. Elements of financial accounting.
May we request that those that didn't unmute, can they do so that there won't be any disturbance?
Right, as I said, your understanding or your of accounting will hinge on your understanding of these elements of financial accounting. So make sure that you clearly understand them. These elements are 5. There are 5 elements of financial accounting. Everything that we report is on these elements. All right, number 1 element, we have got what we call assets. Right, assets are the resources that are controlled by the entity. Right, I'm going to go to the broad definition, but let me just start from a personal level. When we talk about assets, these are your personal resources or the entity's resources. From our previous session, I think we learned that an enterprise can be we can talk about a church, we can talk about a business, all those can be enterprises. Right. So from a personal point of view, you have got your own assets. For example, if you own your bed, that's your asset. Your pots that you have at home, those are your assets. Your clothes that you use continuously, those are your assets. Right. You can talk about if you have got a house, if you have got a car, all those things are your assets. Right. I think those who cannot hear, can you please make sure that you take care of the sound? Because if you're I think you can. Thank you so much, Fabi, for assisting our colleagues. Thank you very much, because if you are muted, you won't be able to hear us. Right. So I was saying the assets are your resources. You on a personal level, the computer that you might be using right now, if it's yours, it's your asset. The phone that you are using now to access this meeting, it's your asset. If you have got a house that you own, it's your asset. If you have got a car that you own, that's your asset. That's from a personal point of view. Now, if we look at a business, if they've got a building where they do their business, where they store their goods, that's their asset. If they've got delivery vehicles, which they deliver goods to their customers, those are assets. Simon? Hello? Okay, maybe it was by mistake. Right. So our definition of an asset, assets are resources that are controlled by the entity as a result of past events. And from which future economic benefits are expected to flow into the business. So we're saying these are the resources. Resources is something that is important, that is of use, that are controlled. When we say controlled, in accounting, when we define a control, like an asset, we don't take ownership. You don't necessarily have to own. As long as you are controlling an asset, then it is taken as your asset. For example, if the business buys a car on credit, a vehicle on credit, and they are paying in installments, according to law, that vehicle is not owned by them. It doesn't belong to them. But the fact that they are controlling the usage of that asset will be taken as theirs. The same as if they buy a building under a mortgage agreement with a bank. Although they are owing the bank, and that until the amount is fully paid, that building is controlled by them. So that will also be regarded as an asset. Right? Examples of assets. Right? We have land. We have got buildings. We have land. We have got buildings. We have got motor vehicles. We have got furniture and equipment. The furniture that you see in ShopRite, where the shelves, those are part of the assets of ShopRite. The delivery vehicles of Pick n Pay, those are part of their vehicles. The buildings that MTN is using, those are part of their assets. Right. We have got plant and machinery. Those big structures that you see in the industrial area where production takes place, those are called plant and machinery. Those are assets. We have got inventory. Inventory is the same as stock on hand. Where you work, if your organization has got stock which they are keeping in the stores, in the stores room, that inventory is an asset of their business. Right? We've got what we call financial assets. That can include, for example, fixed deposits. Fixed deposits. Right? You can go to a bank and then you deposit money, and then you say you are going to take it after, let's say, a year. You are just depositing money every month. That would be a financial asset. We can also have what we call investments in shares. A business, when they have got excess money, they can go and buy shares in other companies. The shares that they buy in other companies, they are also their assets. Right. Then we can also talk about trade receivables or accounts receivable or data. It's one and the same thing. So these are amounts owed by credit customers. You can go and buy a phone on credit from Vodacom. You are their data. you represent an asset because you represent money that they are going to receive in future. In some instances, it can also be called accrued income, which is a amount owed for other income. Right, trade receivables and accrued income, both of them are just amounts owed by clients. The difference is that with the trade receivables, these are amounts that are owed for our main business, whereas accrued income is amounts that are owed for other income that we get. For example, Shoprite, their main business is to sell goods. So what they are owed for goods that they sold, that's trade receivables. But in addition to selling goods, they might also sell airtime on behalf of networks. They might sell newspapers on behalf of the newspaper companies, and they earn a commission. Those are not their products. So that commission, if they are owed a commission, that becomes accrued income. So trade receivables is what you are owed for your main business, whereas accrued income is what you are owed from other activities. Right, then we can also have VAT receivables. Right, if a business is a VAT vendor, that is if they are registered with SARS as a VAT vendor, they charge VAT on their products. That VAT that they charge, it doesn't belong to them, it belongs to SARS. And at the same time, when they buy their own products, they are also charged VAT. Right, so now if the VAT that they were charged is more than the VAT that they charged their own customers, SARS will be owing them the difference. So the VAT receivable is the portion of VAT that SARS is owing the business. So that is also regarded as an asset. We also have things like prepaid expenses. Prepaid expenses or expenses paid in advance. These are expenses for which the business has already made them payments, but they have not yet received the service or product for which they paid. So as long as they've not yet received the service or good, that amount is regarded as an asset because it still belongs to them. Right. Then we've got bank. Bank is only an asset when it's favorable or positive. When we talk about bank, we mean the amount in your bank account. So even yourself, the amount in your bank account is an asset to you. The same a business, if they've got money in their bank account, it's an asset to them. Then we've got cash. Cash, we're talking about the notes and the coins that the business has. That's also their asset. We also talk about what we call petty cash. You will learn that most businesses, when they make payments, they do bank transfers, the e-wallets, the cash out and stuff like that. But sometimes they have to buy smaller things. Now for smaller things, like let's say they want to buy a pen, it doesn't make much sense to do these bank transfers and stuff like that. Or they just want to pay cash flows. It can be inconvenient to do those bank transfers and stuff like that. So they take from the bank a small amount, which they keep at their business premises for the purposes of just making these smaller payments. So that amount, as long as they are still holding it, it's called petty cash, which is an asset of the company because the money belongs to the company. Right, then we can also have what we call cash flows. That can be an amount that is kept by the business for change. Right. In some businesses, petty cash and cash float are one and the same thing. But for others, they are different. Right. So that is that is assets. So these are examples of assets. As I said, I'm only giving you examples. As time goes on, we are going to have to see some new assets, some new liabilities. But I will try as much as possible to make sure that you have an idea from the examples that I give of what an asset is. Right. I will move on to the next element. So this is our first element that we've discussed, which is an asset. Right. Our second element is a liability. In our everyday language, we can safely say a liability, these are amounts owed to outsiders. Right. Some of you, the due date of registration came and you didn't have registration fees. And for you to register, you had to ask your friends and your relatives to borrow money. You had to borrow money. And they gave you money to go and register. That money that you are owing them is a liability. Some of you, at one moment, you have gone to the bank and asked for a loan. That's a liability. Some of you, you have cars that you are driving right now, you bought them on credit. Some of you, the phones that you are using right now in class, you bought them on credit and you are still owing the company that sold you that phone. That's a liability. So I think any amount that you are owing an outsider, that's a liability. Then our definition, according to our standards, our conceptual framework, we're saying a liability is a present obligation. Present obligation. Arising from past events. Settlement of which will result in an outflow of economic benefits. Let me just put this in bold. Right. What we are saying is that a liability is a present obligation. When we say present obligation, that means you are owing now, present obligation, as it's the date that you are preparing the financial records, you are owing there and then. And it should arise from past events. So it's not a debt that you are planning to take in future. It should be a debt that you have already taken. It should have arisen from circumstances that happened before the debt that you are reporting. Then the settlement of which should result in an outflow of economic benefit. That is, for you to go out of that debt, you have to part way with some of your benefits. Either maybe you can be paying with money or you can be paying with other assets, but at the end of the day, there's an outflow of economic benefits that is going to arise. That's a liability. Right. Examples of liabilities. Right. We have mortgage. We have bonds. Right. These two are related and sometimes they can be used interchangeably. This is whereby you buy an asset or you take a loan and then that asset or another asset serves as security for the loan. I think some of you, you know what you call bond houses where you stay and stuff like that. A bond house is it's like a financial institution funds the construction of those houses. Then that house, it belongs to you, but you pay in installments. Legally, it will only belong to you when you pay the last installment. Then if you fail to pay, that house will be taken back. So a mortgage or a bond is just like a loan that is supported by a security of an asset. Right. They can also call them long-term loans. In accounting, when we say long-term, we mean more than a year. So if you take a loan which you are going to pay more than 12 months from today, that's a long-term loan. Right. Then we can also have what we call short-term loans. Short-term loans, these are loans that you go and take for a period that is less than a year. For example, you can go and buy a phone, and then you go to the bank, you ask for a 3-month loan so that you can buy that phone to enhance your studies. Right. So as long as the period for which you are expected to pay is less than 12 months, then it's a short-term loan. Loans can also be called bank loans. Bank loans, that loan is obtained from a financial institution like a commercial bank and stuff like that. So that would be a bank loan. Right. Then we can also have VAT payable. Right. When I was on the assets, I talked about VAT receivable. In the same way that SARS can owe you VAT, you can also owe SARS VAT. That is, if the VAT that you collected from your customers was more than the VAT that you paid out to your suppliers. So if the VAT that you collected from your customers was more than the VAT that you paid to your own suppliers, you are required to pay the difference to SARS. So the difference is called VAT payable. You have to pay it to SARS. Right. Accrued expenses. Right. These are expenses incurred but have not yet been paid for by the business. Right. I think we know even individuals or businesses, they have a tendency of paying for the water after receiving the statement. So you find that you have already used the water for January. You have already utilized it. And the municipality sends you a bill. Okay, I will give you a chance to ask any questions. All right, then they give you a bill for that water. As long as you have not paid that bill, that's an accrued expense. So if you have already enjoyed the benefits relating to the amount owed, but you have not yet paid, then that becomes an accrued expense. All right. Then we also have prepaid income or income received in advance. Right. Prepaid income or income received in advance. This is income that you received from your customers, but by the reporting date, you have not yet delivered the goods for which the customers paid. For example, I think we know that some shops have got a facility of lay-by. Now, that facility of lay-by means customers can pay now. They can pay now for their goods, and then they will obtain them later. So as long as we have not yet supplied them with those goods, then there's a what? There's a as long as we have not yet delivered the goods or provided the service for which they paid, then there's a what? There's a liability. That money that we have, we owe the goods or service for which the customers paid. So that becomes a liability. So any income that you receive in advance from your customers, that's a liability as long as you have not yet paid, you have not yet provided the service or goods that were paid for by the client. Right. Then we also have bank overdraft. On the asset I talked about bank. Right. It's very possible that you can go to your bank and arrange for what we call a bank overdraft. A bank overdraft, this is whereby you are allowed to withdraw more than what you have in your account. So that means at the end of the day, you will have a negative balance. So a bank overdraft is a negative balance. So this is a what? A negative or unfavorable balance. Like businesses, they can go when they foresee that they might have challenges in finance or in cash in the future. What they can go and apply for an overdraft facility. The bank can grant them that overdraft facility, which allows them to withdraw money which they don't have in their account. Right. Then we also have what we call creditors or trade payables or accounts payable. Right. These are amounts that are owed to suppliers for goods and services. Right. That means we have already received the goods or services, but we have not yet paid. That is a liability. So these are examples of liabilities. So at the end of the day, anything that results in you owing money to an outside party, then that's a liability. Right. Then that's what number 2. Number 3. We also have what we call incomes. We also have what we call incomes. Right. With incomes, these are the day-to-day economic benefits going into the business. And very soon I'm going to mute you guys. Then if you have to, when you contribute, when I invite you to contribute, then you can contribute. All right. So these are the day-to-day economic benefits flowing into the business. That is the simple definition of that. All right. Then the broad definition that we use in accounting. The broad definition that we use in accounting, we say that incomes right are increases in assets or decreases in liabilities, resulting in an increase in equity other than those resulting from contributions by equity participants. Equity participants are the owners of the business. So if the amounts come from the owners of the business, they are not income. They are not income. they will be on a category that I will be looking at a later stage. So we're saying incomes normally either result in an increase in an asset or a decrease in a liability. So there is an enhancement of assets there. And that at the same time, it should also result in an increase in equity. But it should not be a contribution by the owners of the business. Right. Examples of incomes. We have sales. Sales will mean income that is received from the sale of goods. So ShopRite, when they are selling today, all the sales that they made today, that's their income. We have what we call services rendered. This refers to money that is earned for providing services. For example, an electrician service. Right, an electrician can come and at your office, and then he sorts out the electricity, then he bills you. Then you call it services rendered. That's income to him. They can also be called fees. Right, with UNISA, when you are paying your study fees, the income is called fees. With UJ, that's the same. University of Johannesburg. With the University of the Northwest, it's the same. University of Cape Town, that's the same. The schools, the high schools where our children are going, they pay fees. Fees is income to those schools. Right. We can also have what we call donations received. If you happen to receive a donation, then that will be an income. Right. Grant received. Maybe let's say the government has introduced an incentive for all businesses that are going to operate in the rural areas, and they give you a grant. That will be regarded as income also. Right. Then we talk about interest income. If you put money in a bank, you are going to earn interest. That interest is income. If you give a loan to another business or to another person and charge them interest, let's say your business also gives loans to employees when they have difficulties, and they charge a smaller interest. Whatever interest that they will be charging will be regarded as income to the business, as long as the business is the one that is charging interest and that is entitled to receiving the interest. Right. Then we have got commission income. Some businesses, they can sell goods on behalf of others. For example, you'd find that Pick n Pay will be selling newspapers. They sell airtime. It's not their product. Then in turn, they can earn a commission. It can also happen that, let's say you are operating your shop, but your cousin does not have a shop, and he introduced this new clothing label. Then he asks you, please, can you sell my clothes in your shop? And if you sell them, I will give you 10% interest. Whatever interest, 10% commission. That commission that you are entitled to you is called a commission income. Right. We have rent income. Some businesses, you'd find that sometimes they will not be using all the space that they have. They might not be using all the building that they have. So instead of just the building lying idle, they can rent it out. Whatever rent they are going to receive, it's income. Right, we've got what we call credit losses recovered. Right, I would start by describing credit losses, which I'm going to talk about on expenses. Right, to boost sales, most businesses, they also sell on credit. But unfortunately, selling on credit is a risk. There is a possibility that some of the customers can fail to pay you. They can disappear without paying you. Right. Now, if that happens, that would be what we call a credit loss or a bad debt, which is an expense. But it can happen that some of these customers, after you have written them off, forgotten about them, treated them as bad debts, they can at a later stage come back and settle their debts. Now, if a customer that we had written off comes and settles the debt, we call it a credit loss recovered. And that credit loss recovered will be treated as income. Right. So those are examples of incomes that a business can receive. Right. I'll then move on to the fourth category. We have got expenses. These are the day-to-day running costs of the business. Right. In as much as you would not like to incur costs in a business, but it's impossible for you to run a business without cost. You would need water. You need to pay for electricity. Right now, people are trading online. You would need data. You would need your telephone. You would need advertising on social platforms, on television, on radio to advertise your product. You would need some employees and you have to pay them salaries. So it's unavoidable. Actually, one of the downfalls of most businesses is over expenditure. So every business actually incurs expenses. So whether you like it or not, at one stage you will have to, in fact, not on a daily basis, you have to incur expenses in your business. And through those expenses, those are the ones that can allow you to earn income. All right. So broadly, we describe it as decreases in assets or increases in liabilities. Resulting in a decrease in equity, other than those relating to distribution to equity participants. Right. So at the end of the day, an expense will either result in a decrease in an asset or an increase in a liability. Right. It can either result in a decrease in an asset or an increase in a liability. And at the end of the day, there should also be a decrease in equity, but it should not be resulting from distribution to equity. Like in the form of business that we deal with, distribution to equity can be in the form of drawings. Right. Now let's look at the examples of expenses. you'd need your water and electricity to run your business. There can be rent expense. You saw that on the incomes I talked about rent income. Rent income is whereby you are renting out your building and receiving income. On the other hand, it's possible that you don't have your own building, but you are renting. Now, when you rent a building and you pay rent, that rent expense, that rent that you are paying is an expense. Printing and stationery. You might go to the internet to print some documents, or you might need to fax, or you might have to buy bond paper so that you can print. You might have to buy books, receipt books. You might have to buy invoice books. All those things that to be part of printing and stationery. Then there can be interest expense. Right? If you take a loan or if you buy on credit, your creditors can charge you interest on the amount that you are owing. So whatever interest that you are charged, it's interest expense. On the incomes, it's you who is charging interest. But here now, we're talking about a situation whereby you are charging, you are being charged interest. Maybe you've got a bank overdraft, maybe you took a loan from FNB and FNB is charging you interest. Whatever that interest is an expense. Right. We also have repairs and maintenance. On a daily basis, you have to maintain and repair your assets and stuff like that. All the repairs that you do, they are treated as an expense. Right. We have got credit losses. I now come to credit losses. On the incomes, I talked about credit losses recovered. I'll just repeat. A credit loss, this is what we used to call bad debt. It's the same as what we used to call bad debt. This is whereby we have got customer we sold to on credit, but they've disappeared. For example, maybe they gave you a contact address. You call their workplace. You are told that I know he left. He's no longer working here. You have got his phone number. You call his phone number here that is not available, or the phone number is no longer being used by the person. You try their home address. You are told that he was lodging here. He's no longer here, and you can't find that person. Or maybe there's confirmation that your customer who owes you died. At the end of the day, you have to write off that debt. So when you write off a debt that you are owing, that's what we call credit losses, which is an expense. Right? We've got insurance. I think you know the risks that that happen. I think we saw on the July unrest in South Africa about a year or two ago, there was a lot of damage that happened of the property. We also saw what happened with the floods in KZN. There was a lot of damage to property. So you'd find that if you have got insurance, then you can be able to be compensated by insurance if they cover such events. So you find that most businesses, they also take this insurance. So whatever insurance installments that they pay, they are expenses. Purchases, that is when they buy goods that they resell. Like you'd find that in our module, we'll mainly be talking about businesses that buy and sell. We don't normally talk about manufacturing businesses in this module. We talk about businesses that buy goods and then sell them. We're talking about carriage on sales. This is just transport costs when you sell your goods. When you are selling goods, you might need to transport the goods to your customer's place. You can also have carriage on purchases. Maybe you are buying goods. You are buying goods from Durban and you are in Cape Town. You would need transport to transport the goods. Import duties. Maybe your goods, you don't buy them locally. Let's say you are buying them from Zimbabwe. You might have to pay import duties for importing those goods. Right. Then we might also have commission expense. You might be selling your goods through intermediaries who are called salespeople, and then you pay them a commission. So the commission that you pay them, that's also an expense. Right. Then we also have wages and salaries. That's compensation for your workers. Wages and salaries is compensation for your workers. Advertising. You might have to advertise sometimes in the newspapers, in the televisions, or you hand out pamphlets. That can also be part of the cost of advertising. Municipal rates. That you pay, they are also an expense. Fuel costs. Fuel that you have to buy is also an expense. Then we also have what we call depreciation. As you use your assets like motor vehicles, furniture, as you use them, they are bound to lose value. So in accounting, that loss in value in your goods, we call it depreciation. The loss in value in your goods, we call it depreciation. So we also measure that. So these are just examples. There are a lot of expenses. Some of them will meet them later in our studies. So these are what we call expenses. Right. Then the last category of the elements that we have what we call equity. Equity, this is the interest of the owners in the business. That means what belongs to the owner or the owners. Like here in our module, we'll only be talking about one owner because we'll be looking at a sole trader. The business that we deal with is only owned by one person, but those who are doing 1601, who are also part of us, you also deal with partnerships, company, and close corporations, where we have got multiple owners. Right. The other definition that we have for this one, the broad definition of accounting, right? The residual interest of the owners in the assets of the business.
Yes.
After deducting liabilities. So what belongs to the owner is what we call what we call equity. Your investment in your business. That's what we call equity. Right. This equity of equity items. Right. We have got capital. Capital comes in as a plus. Capital refers to all resources that are contributed by the owner. And when we say capital, please, it's not only money. Because some students, they think capital is money that you contribute. You can contribute furniture, you can contribute a vehicle to your business. That's still capital. So it's anything that you contribute at any stage of the business. What some say capital is the amount used to start a business. It's not only when you start, even when you are 10 years into the business, you can decide to pour in more money, to pour in more resources. As long as the owner is pouring in resources into the business, that's capital. Right. Then we also have what we call drawings. So maybe on capital, let me just expand and say that all resources contributed by the owner. So anything that comes from the owner or owners of the business. Right. Drawings, they result in a decrease in the equity. Drawings are resources taken for personal use. By the owner or owners. If they come and buy and pay cash, that's not a drawing. Or if they come and buy on credit and then pay later, that's not a drawing. A drawing, this is whereby they take and they don't pay for it. So that will reduce their equity. Then there is also here now, element 3 and 4 are also part of equity. So the income that we talked about on number 3 and the expenses on number 4, they also belong to the owner. They come in as profits, which is what? Income minus expenses. So a profit arises when the incomes are more than the expenses. And that profit belongs to the owner or the owners. That's why we also include it under equity. So at the end of the day, element 3 and 4 will be absorbed in equity. They will be part of equity. They come in as a profit or loss. Right. As we said, the profit belongs to the owner. The loss can also belong to the owner. That is when expenses are more than incomes. Then we've got a loss. That loss will also belong to the owner in as much as he likes the profit. So if the business makes a loss also, whatever loss is made will also be his or hers. Right. So this is our equity. Right. So at the end of the day, we're saying incomes and expenses will become part of equity. So we'll just be left with 3 assets, equity and liabilities, which brings us to our basic accounting equation. At any moment in time, our assets should always be equal to equity plus liabilities. Our assets should always be equal to the equity plus liabilities. We can change the subject of the formula using our mathematical skills to change it to equity is equal to assets minus liabilities. Or alternatively, we can say liabilities is equal to assets minus equity. So as long as we know 2, we can use any of those 3 parts to determine our the one that is missing. Right. So those are the 5 elements of financial accounting. So all accounting that you'll be doing, you'll be reporting on these 5 elements. And you can't proceed with accounting if you don't understand these 5 elements. Because as I said, they will affect almost every topic that you'll be doing. Almost every topic. 70% or to 80% of accounting, financial accounting will be affected by this, your understanding of assets, equity, liabilities, incomes, and expenses. Right, at this stage, I would invite any questions pertaining to the elements of financial statements that I've addressed. It appears there are no questions. Right, if there are no questions, that means we have totally understood. That's my understanding there. Right. So now at this stage, I would like to invite Mr. Junior. I've covered the elements of financial statements and there are no questions. So now for all other issues that are administrative, I will end this class to Mr. Junior, and Mr. Junior is going to address you. Mr. Junior.
Mr. Eugene, thank you very much.
Yes.